Yeah, that's absolutely right, Steve. If you look at the US oil companies, and we saw this actually at CERAWeek at the beginning of the year, their purpose is much clearer. They're all about maximizing returns from the production of oil and gas now. They were unapologetic at CERAWeek about the need to produce more hydrocarbons. The message was, it's not the oil, it's the emissions. We need to get rid of the emissions. That's what we're going to do and work towards. It's a little bit more complicated for Shell and some of the other European majors. And the big issue, some investors would say, it's not energy transition for Shell that it needs to be concerned about, and that Wales Sawan needs to focus on. It's declining production, and you've seen this since 2019. Shell's been fighting a losing battle to hold up its production. All those gains that it got from the takeover of BG in terms of barrels of oil equivalent, and the massive volumes of gas.
Gumph goes around. There's some truth, but a lot of gumph goes around about European companies intrinsically trade at a discount to US companies. I don't believe that's always true. I believe it sometimes is the case. Shell trades on 8.4 times forward PE. Exxon trades at 12.8 times forward PE. In your humble opinion, and your very educated opinion, would it matter if this was a US company rather than a London-based company?
No, I don't think it would. I mean, operationally, you could argue that it would have a benefit for Shell in some way. I mean, Shell has lost ground in some of these American plays that you're seeing in the oil industry at the moment, specifically in Latin America, Guyana, and the US oil majors have definitely stolen a march there. Would it be an advantage in terms of leveraging a position in US shale, which is the big driver in upstream globally at the moment? I mean, of course, those PE ratios are really a reflection of upstream production. And outside Namibia, it's difficult to see kind of where Shell is going to add those extra barrels going forward.
Andrew, I want to pick up on Aegon's concerns around the energy transition plan here. Effectively, they want to know in the vote today, they're saying that the strategy doesn't target scope 3, so we're talking about value chain. As we talk about a lot of sectors on this program, one thing that jumps out is that we're seeing much more corporate leadership around green transition, green goals than what you're seeing from a lot of governments. But in this particular case, in this particular sector, it seems as though Aegon is saying, look, Shell is not showing any leadership here. It's not setting course. Therefore, it's not having any impact on the value chain, with smaller companies then following suit. Do you believe in that argument? Do you think there should be more leadership from Shell on this issue?
Well, I think, is it Shell's responsibility to take a leadership position here when the rest of the industry is going in the opposite direction? You could make the case that it would kind of single Shell out as being an outlier, especially when you have the likes of OPEC, which controls global energy supply at the moment, and certainly controls the price to a greater extent. Messaging in the opposite direction. All the messaging from OPEC is that we're still going to need lots of volumes of oil by 2050. Our own estimates at S&P Global Commodity Insights suggest that we're going to need about 73 million barrels of liquids by 2050, even with the Paris Agreement and the national commitments to reduce emissions over that period. So is it really for Shell, BP, Total, these European oil majors to take a leadership position here, or is it really for the investors to say, well, we're prepared to take a haircut, we're prepared to take lower returns to do a greater good, which is lower emissions? It's a difficult question to answer.